Okay, welcome back from lunch. To change the paradigm, let's consider U.S. international tax reform from the perspective of the other side of the Atlantic. How are our U.S. trading partners in Europe responding to U.S. international tax reform? Are we headed to a new round of global tax competition? For this topic, our panel will be moderated by visiting Professor Wolfgang Schoen, and panelists include Steve Edge, representing the United Kingdom, Adrian Crawford, representing Ireland, and Professor Johanna Hay, representing Germany. Visiting Professor Wolfgang Schoen is director of the Department of Business and Tax Law at the Max Planck Institute for Tax Law and Public Finance in Munich. He currently serves as chairman of the board of the European Association of Tax Law Professors. Professor Schoen was a member of the global faculty at NYU Law School and a visiting professor at Columbia University, the University of Pennsylvania, and the University of British Columbia. Steve Edge is a partner with Slaughter and May, based in London, and is one of the United Kingdom's leading authorities on corporate tax law. A large part of Steve's practice involves advising non-UK multinationals on cross-border transactions. Steve was called upon in 2011 to give evidence to the Ways and Means Committee of the US Congress about the UK experience in adopting a territorial tax system. Adrian Crawford is a partner in the International Corporate Tax Group of KPMG in Ireland and also heads up the Irish Tax Center of KPMG based in New York. Adrian is a former president of the Irish Taxation Institute, the premier body representing the tax profession in Ireland. Professor Johanna Hay is a professor at the University of Cologne, Germany, and serves as the director of the Institute of Tax Law at the university. Professor Hay was a visiting professor at NYU Law School in 2015. Professor Schoen.
Thanks, Larry, for this very friendly introduction. Thanks to you for coming to this European panel, as it has been called, and you have learned from what Larry said and also from the program that these three guys represent their countries. I represent NYU Law School, which means that I'm the first time for me to be the US guy on the panel. Now, we have tried to address the issue of what are the reactions, what is the perspective from the side of the European countries, not necessarily from the side of the European Union as an institution, but from the side of the European countries in a multi-layer perspective. We would like to have a look at the challenges to non-US governments as opposed to the challenges to non-US business, because those are different challenges. The challenges to the non-US governments will refer to the issues whether they should react either by legislating, whether they should react by coordinating, whether they should react by going to international institutions like the OECD or the WTO, or have the European Union taking some steps. Those are the options. And also non-US business, because they have to think about what is the impact on their structures, what is the stability of the reform that has been brought about here, etc. Now, I would like to cabin that in a certain fashion, and I would like to start with the question, the United States as a competitor for investment. Is that a challenge for non-US countries? Now, the reduction of the US corporate tax rate from 35% to 21% is indeed a major step. It's a major step which brings the United States to the fore of the competitive countries when it comes to the rate as such. But one should not think that this 21% rate is per se an extremely low tax rate. When you look at these countries here, we have Adrian from Ireland, 12.5%. We have Steve from the UK, 19%. We have Johanna from Germany, nominal corporate tax rate, 15%. Now that's a joke, because we have a business tax on top of that, another 13%, that would be 28%. But then you have state corporate tax, which brings it up to an average of 25%. And then I would say 25% as compared to 28% in Germany, 25% very soon in France, 27% in Italy. I would say the United States, when it comes to the corporate tax rate, is not a huge winner here, but of course it has made up a lot of having fallen back before. But are there elements in the new legislation which make it attractive for countries to move their, for non-US governments, no, for businesses to move to the United States, and that might be something other countries might take into account. I think that FDII is an important thing here, but we will discuss the compatibility with WTO law. I'm a bit interested in what the full expensing that is now allowed when you invest in the United States will mean. That can be highly attractive for non-US corporations if they would say, we set up a new establishment in the United States and we got full expensing on all the movable assets. That might be a big deal. Now, competing for business is one thing. Competing for the tax base is another thing. And that's where we talk about BEAT. It's where we talk about GILTI. We just heard from the previous speakers that BEAT is probably not compatible with WTO rules. It's probably not compatible with treaty rules. I would fully agree with that, having worked both in tax and in trade law. This is a clear case of something along the lines of the DISC legislation, the FSC legislation in the United States, and BEAT, which is kind of a follow-up to the non-deductibility of foreign expenditure under the Ryan-Brady House Plan, is exactly along the lines of what has been said before. This is not mere ensuring that taxes are collected in the right fashion. This goes beyond transfer pricing control, and this is, in my view, clearly not compatible with WTO law. Now, the GILTI thing is, from the perspective of other countries, the most interesting part, because the GILTI part is the one which lays out worldwide taxation for a specific kind of income under certain requirements. So European countries are told, well, US goes territorial under the new tax reform, but wait a minute, it goes worldwide for a lot of income, and insofar this is something that goes for excess profits that's extremely important for local subsidiaries of US multinational worldwide, and the countries out there will have to consider to what extent the existence of a reduced tax credit will be sufficient to keep the investment in their countries. Now, when you turn away from the question whether the US is a competitor to other countries, it might be a role model. It might be a legislative laboratory. Is full expensing something that should be accepted in other countries as well? It goes into the direction of a cash flow tax. Proposals like that have been made in different countries before. I think many countries should think about that. Pass-through taxation, as you have it now in the United States, the 20% deduction is completely new when you do it when you compare the situation in other countries. But the problem that is to be addressed here, what do you do with transparent entities, with pass-through entities, once you have reduced the corporate rate to a large extent? That problem is well known in Europe, and there are a lot of different answers, a lot of different legislatory reactions, and I think people will take a closer look at how the US situation works out. I do not think that FDII will something other people will follow up, given the WTO problem. Again, BEAT, GILTI might look interesting for all those countries who are unsure to what extent their CFC legislation is still workable. GILTI might be the simpler, more far-reaching solution. The problem for many European countries is that European law prevents them from taking action that treats cross-border investment, cross-border services, cross-border establishment worse than local things. That is something the US has more freedom here, Asian countries have more freedom here. The Europeans have locked themselves in to a certain extent. So they cannot go that far as the US can do. Now, does this lead to the United States as a role model? The big question here is unilateralism the new paradigm? And that would be a sad thing. We have seen the BEPS action plan. We have seen the G20 activities. We have seen the creation of the inclusive framework, more than 100 countries around the world coordinating their tax policies. The BEPS action plan was very friendly to the United States because all the minimum standards, all that was mandatory, was basically in line with what existed in the United States before. BEAT and GILTI clearly go beyond the consensus. There is an increased interest in WTO law. We haven't seen that before. And for me, WTO law is like a thermometer. The temperature rises, the more WTO questions you get, including questions on our side, like the digital tax on the US internet industry. And I think one should find back to a path of coordinated action. Challenges to non-US business, I will not deal a lot with that. I'm an academic, but they will have to think about restructuring their corporate and financial situation. They will have to reorganize their value chains. They might think about relocating headquarters to the US, or maybe GILTI and other stuff shifts corporate headquarters out of the US back to Europe. That is something my colleagues will have more to say on, and we start with Adrian.
Thank you, Wolfgang.
Just the green button.
Okay. So I'm not giving any secrets away when I say that a lot of US multinationals operating in Europe would have had their principal operation in Ireland or their headquarters there. And a lot of the groups would also have used IP structures. In other words, structures where the rest of the world IP or the European IP was in an offshore company, possibly an Irish incorporated, non-Irish tax resident entity. And US groups were already thinking about what they did or should do with their IP even before US tax reform. The reason for that was twofold. Firstly, Ireland a number of years ago had decided to phase out this concept of an Irish incorporated, non-Irish tax resident entity. Basically, those types of entities will automatically become tax resident in Ireland at the end of 2020, absent moving their management and control to a tax treaty country with a tiebreaker clause. Secondly, of course, as a result of OECD, we have this requirement to have DEMFI functions with the IP owner to justify a large IP return as opposed to a money box return. So groups were having to think about that even before tax reform came along. Some groups had already decided to onshore to Ireland, get tax depreciation because they could build up their DEMFI functions there over time. Suddenly we've got tax reform here and we've got FDII. So groups, of course, will think about, well, if we're onshoring, do we now think about onshoring back to the US? And modeling is very important because the new tax regime is so complicated, and on a year-by-year basis, results can change. You can lose tax credits because, of course, under the GILTI or in the GILTI basket, you've got the 80% haircut, and then, of course, you cannot carry forward any unused tax credits. So you really need to try and model very carefully. On the face of it, the GILTI rate trumps or beats the FDII rate. On the other hand, you do have this requirement for DEMFI. So perhaps if you were a young, emerging startup thinking about what you would do with your IP, in the old days, if I can put it that way, you might have said, well, look, we'll move our IP offshore before it gets very valuable, or rest of world offshore IP. Now you've got to figure out DEMFI. And of course, for a lot of groups, the DEMFI functions are in the US. And if you're a smaller group, the pressure and the tension in trying to get DEMFI functions outside of the US is a lot greater. For larger groups, that tends not to be such an issue. But I think one of the important points coming out of the new regime is the requirement for a very stable, predictable, and robust tax structure. You really need to know where your income is going to be as best you can, that your transfer pricing is very robust, simply because you can lose your foreign tax credits if you're not careful. There was a report called the Coffey Report in Ireland last September. What was the Coffey Report about, and who was Coffey? Well, Coffey is a professor in Ireland. The report was commissioned by the Irish government, essentially to see if the Irish tax code was fit for purpose, so to speak, in the modern era. He wasn't asked to look at the corporate tax rate of 12.5% in trading income, which is essentially almost like a brand for Ireland right now. It's got cross-party political support. I think Ireland would need to be invaded before we would give up our 12.5% corporate tax rate. But Coffey was asked to look at rules for tax depreciation on intangibles, at our transfer pricing rules, etc. And he made certain recommendations, one of which was that if you onshored your IP, that there was a kind of a haircut, but a haircut with a carry forward on the amount of tax depreciation you can use in any 1 year against income from the IP. Basically, you can only shelter 80% of the income derived from IP in Ireland in any 1 year, but the excess depreciation can be carried forward. Second point was, he said, look, Ireland, really, we've got to be a good citizen and adopt the OECD guidelines, including the DEMPI rules, which we will definitely do. The only question is when. And what Coffey said is we should do it no later than the end of 2020, which interestingly coincides with the sunsetting period for the NRIs, or non-resident Irish incorporated entities. So obviously groups have a lot to think about if they've got IP offshore or if they've got IP onshore and they think they're going to be selling and growing overseas. Perhaps one thing which Ireland has got for it, when you go back to this importance of a stable regime, as I say, we've had a low tax rate going back to 1956 actually, when we had a very agricultural economy, and you actually had a zero rate then if you manufactured and exported. And we kept that zero rate until we joined the EU, when you cannot distort trade by giving preferential treatment to exports. Then we had a 10% rate of manufacturing, and then EU state aid rules said you cannot give favourable treatment to a sector of an economy like manufacturing. And then we said, what the heck, we'll just have a 12.5% corporate tax rate across the board. So perhaps Ireland would be an interesting hedge if you were onshore, because of the stability of the system, and then maybe concerns about FDII in the US and the WTO, as was discussed this morning. Now, obviously, there's lots of other things floating around, like digital profits tax and CCCTB, and I know Stephen may touch on digital taxation. So there's lots of things to put in the mix. That's Ireland.
Thanks, Adrian. And now we'll have Johanna from Germany.
Yeah, thank you, Wolfgang. Well, the German situation is, of course, quite different than Ireland or UK, because Germany is one of the last high-tax countries with a tax burden of around 30%, depending on what the local taxation is, and that is significantly above the OECD average. And this problem is nothing totally new. The last tax cut we had in 2008. But in the past, we could always point to the US and say, you know, there are other countries which do not really have the necessity to follow up in this tax competition battle. Now, we lost somehow our last companion in being a high-tax country. And that, of course, also changes the picture quite a bit for German multinationals. Wolfgang said already, I'm also a professor, so I will not talk about what German multinationals really do, but I think there is some likelihood that, especially if they are already invested in the US, they will, if they talk about additional investments, they will of course consider the US as being more attractive than the German location, especially also because of the full expensing. And then if, and Professor Rosenblum also said that if the business model fits into these new rules, that might be really a reason to invest in the US. What does the German legislator or the government do about it? Actually, nothing. It's really a little bit disturbing that in the coalition contract, which was concluded in March 2018, so already under the impression of the US tax reform and of course, increased pressure on German tax rates, this coalition agreement contains nothing about cutting the tax rates for the German corporate income tax. It has, again, a strong commitment of tackling tax avoidance and following the OECD BEPS recommendations. So that means that Germany probably will continue what it did in the last decade, being very active on abuse legislation, anti-avoidance legislation. And that brings me to the second part. So how do the German rules interact with what the US did? So first, maybe only a short point. Under German CFC considerations, the US is a tax haven. This is a little bit surprising, but we have a threshold in our CFC legislation of 25%. So everything what is effectively taxed lower than 25% would fall into our inclusion taxation if it's passive income. I mean, of course, depending on the state taxes, that might be not a major issue, but I mean, just to show you the perspective of Germany being a real high-tax country, well, one has to notice. I think the most interesting, and I will take a little bit more time to talk about that, is a quite new anti-avoidance rule which we enacted in 2017, that is a German royalty barrier. We have also an interest barrier which resembles somehow what you did now in the new 163J, but this royalty barrier is something sort of unique because it was mainly enacted in 2017 to tackle patent boxes which are not in line with the OECD Action 5 recommendations of the modified nexus approach. So how does that interact with FDII or FDII, however you pronounce that? So if you look at it, and I can follow up immediately with Matthew Geo, which I think who made it very clear the problem. The first, what you have to look at is whether FDII is a preferential regime. Because the German royalty barrier basically says if you have royalty payments to a related person, 25% or more, and this payment is taxed in the hand of the recipient lower than 25% due to a special or preferential regime, then the deduction will be restricted. So, and I think this is, of course, an interesting question. Is that a special regime? I would agree that it is. You could, of course, say, but it is not really applying to royalty income because it is some deemed intangible income. However, the German wording of this rule in the German income tax code, it does not really require that it is a preferential regime restricted to royalty income. It just says any preferential regime, and I think for that reason it is quite clear that this falls into the scope. So that is the basic rule, and then there's an exit clause. So you may still deduct your royalty payments if this preferential regime follows the OECD nexus approach. And I think that is very difficult to apply. I mean, you could, of course, say, well, FDII is nothing like a European patent box because it is sort of, I mean, combined with guilty has a different purpose. But, I mean, you could also say it clearly is not in line with the modified nexus approach. And then, I mean, it's really difficult to come to a real certain answer to that. Germany, the officials did not have really published an opinion on that. It might be that they wait for the OECD, and then we are again at that point that the OECD now first will analyze FDII, and then this might be a basis for the German tax authorities to apply this royalty barrier and also for future WTO cases. Okay, thanks. I think this is, for now, maybe the German perspective, and I hand over to you.
Walk up there.
Thank you. Thank you.
Can you comment on the extent to which you monitor within Germany inward investment and the extent, because clearly Ireland's been a fantastic success story, I think, and I'll talk a bit about that later, even though I'm doing the UK bit. But do you monitor inward investment and whether you're winning more people setting up new factories in Germany, perhaps foreign investors rather than local investors spending money there? Is that not something that, because you've got such a magnificent economy and magnificent industry?
Actually, Steve, if I may follow up on that, when the US entered the tax reform, or when it became clear that there would be a major tax reform after the presidential election in 2016, I had a meeting with the director of the International Tax Office at the ministry in Berlin. I said, what are you going to do about this? And they said, we have a bet. We still think that the infrastructure we offer, the well-educated people we offer, the legal protection system, the agglomeration effects, all that will be sufficient for people to come in.
No.
And when you look at statistics by the World Economic Forum, by the World Bank, etc., tax is an important factor, but it's not the most important one. It can make a difference on the margin.
Yeah, I agree.
But how big that margin is, actually the German government is having a bet on that this margin
I
still exists.
absolutely agree with that. And we all tend to think, perhaps because we're at a tax conference, that tax is the most important thing in the world, but it's not. And there are a whole lot of things that will decide it. Tax can make a difference at the margin. Funnily enough, when I did my Ways and Means thing a few years ago, people said, well, the UK is mad. Your generous CFC regimes, all your businesses are going to move offshore, and they forget that actually businesses don't move for tax. They move for other things. And having a good location, having an educated workforce, all those other things are important. Sorry.
But I might add that this is, of course, we should not overstate the tax aspect. But as I said, if the deal is really fitting into these new rules, and if especially people think they can work around BEAT and all these bad stuff in the US, I think then this is really an incentive to go to the US. And for Germany, we always point to our non-tax assets, but I think this is also questionable to some extent.
Well, and you're right to point to those, and we'll have a conversation, I think, a little bit later on, if we can, about a race to the bottom.
Maybe just one word on this.
Yeah,
I think
I'll do my video.
those businesses who want to sell their goods to the United States,
Yeah.
those businesses have the largest incentive to move their activities to the United States. Given BEAT, given also the elements of FDII that might be interesting, those businesses who want to cater to the world will not be that interested. But you want to be on the safe side when you sell to US customers.
I agree. And it's, at that point, a great game of poker, isn't it? How far can you push people with the bet? And perhaps at the end, we might just talk a bit about digital tax as well, because I think those issues come up. So what's been the reaction in the UK to US tax reform? And seeing, as we've, I think, seen illustrated in the very interesting talk so far this morning, an enormous clash of economics and politics. Call me young and naive if you want to, and I wouldn't mind one of those. But, I thought there ought to be a principle behind taxation. And I can't remember, I think it was Michael who said this morning, don't expect anything to be intuitive going forward in the US tax system. Well, that's a shocking condemnation, because I think, we all understand why as individual citizens we're liable to tax in the countries where we're resident. Corporations, it's a deal. And there should therefore be a clear principle that if you've got a platform in a jurisdiction, and we'll talk about digital platforms later on, but a physical platform, that you're using the facility of that country, and there should be something that therefore justifies why you're paying the tax. It's like a hotel. If you check in, you expect to get what you're paying for, and you expect to have to pay for it. So there's been a certain amount of incredulity about this idea of taxing people, and we've done it, I'm afraid, with banks, and some would say, I'll come on to that we've done it with diverted profits tax. I don't think we have. Taxing what you can because they're weak, or because they don't vote in your elections, rather than what you should, I think is is a way of making tax almost impossible for people to pick up and learn, even in an institution like this. So, and in the UK as well, I think there's a certain amount of incredulity as to whether this will ever come to pass. I hope I'm here in 10 years' time, but will this all be sorted out by then? Who can tell? And certainly within the UK, people look at this and wonder whether actually it will ever see the light of day, and if it does see the light of day in full, whether actually the Democrats will come back in and change things. So business decisions are not necessarily going to be taken based on what they see as the current regime, because they don't see that with great clarity. The other bit, which Wolfgang raised, is does this change the competitive balance? And I think the point that Wolfgang's just made is absolutely true. You're usually in a jurisdiction for a whole host of reasons rather than tax. And if it's an expensive place to be, whether that's living in Belgravia in London or doing business in New York, there's usually a good reason for that. Lots of people want to be there, and the price goes up. So high taxes won't necessarily discourage people. There was a time when I thought the UK and the US, even though we're a much smaller economy, were in competition for having the worst tax system in the world. I'm not sure who won. Stamp duty certainly stopped a lot of UK M&A deals, but there was a great big fight on transatlantic mergers as to who should come out on top. US with its high, this was before the 86 reforms, high tax rates and incredibly penal subpart F rules, or the UK with its stamp duty, which after all is what lost us America all those years ago. I'm sure you're doing quite well, actually, under independent management. And also we had then an ACT regime, which some people in the room might remember, which meant that companies had to pay corporation tax when they distributed dividends, even though they may not actually have any tax liabilities. So a company like BP was a huge lender to the government, paid no UK taxes with all its business overseas, brought dividends back to the UK, paid them on to shareholders, but still had to pay about 2/3 of its UK corporation tax bills. So I don't know quite who won that battle, but obviously the Reagan years and the Thatcher years changed that. So if I just look at, picking up some of the points on this, what the view is of the UK to what's going on at present, and does US tax reform having a big impact? Well, of course, we've got quite a lot going on in the world at present. I'm old enough to remember thinking as a teenager what I would do in my last 4 minutes when Cuba was happening. And, I'm thinking a little bit about that now. It certainly seems a bit tense. I'm probably doing different things than I was thinking about as a teenager, but there we are. We've also got Brexit going on in the UK, and that's certainly concentrating people's minds. I'm an optimist on Brexit for the financial sector, and that's the way the press seems to be going at present. There's just a huge amount of infrastructure there. And I'm also now an optimist for the UK generally. So it's not the highest thing on our radar screen. Probably Brexit is more important than US tax reform. For those UK multinationals who are investing into the US, I think the net view is that actually the lower rate, given that we're now a territorial regime, having brought ourselves into line with the rest of Europe, with certain modifications and some criticism from the EU of our CFC rules recently, that actually it's a net positive. And why is it a net positive? The lower rate. Most UK multinationals operating in the US in previous years will have demonstrated what, to my mind, was the absurdity of the US tax system under previous management, which is they were paying a higher rate, but they were allowed to gear up much more highly than their US domestic competitors, and as a result, they could manage the base and the rate wouldn't hurt them as well. And that's clearly absurd and was anti-competitive when domestic businesses here were paying more tax than their foreign inbound competitors. That has gone, and that's probably a good thing, both for the US and for companies doing business in the US. BEAT has obviously been a difficulty, but I think people are looking at that and saying we can probably restructure around that, as people have said this morning, and therefore the low rate certainly compensates for what we may lose on the roundabouts of BEAT. For inward investment from the US into the UK, again, come back to Wolfgang's comments, we think we've got a good number of things to offer. Certainly the US tax system with deferral in the past has had an impact on UK markets. There have been a number of big takeover bids where it's been thought that the urge to invest to prolong a deferral has perhaps made people buy British companies or other companies in Europe at a slightly higher price, and that's a sad thing, I think, for the US, and actually a sad thing for the economy into which they're investing. Inevitably, the stateless income, we have had so much trouble in the UK with transfer pricing, because if you point to some guy sitting on a deck chair in Bermuda and the profits that he's earning for the enterprise that he works for, where he just happens to own the IP, and you say to the revenue, yes, that really belongs in Bermuda, and they say, well, it looks to me like a man in a deck chair. What have you got more than that? And how does that fit in with DEMPI? And I'm afraid the only way we can then deal with it is to say, well, strange though it may appear, because they do have transfer pricing rules, this really belongs in the US and they're just not taxing it. And that's not satisfactory. Whether that will come to an end now and what will happen with IP, I don't know, but I hope that it will. Again, perhaps a commentary on how sure people are that they're going to see this through to the end, and it's not going part to be reversed by a different government coming in, is that actually, people are not, in my experience, radically restructuring their IP ownership. WTO, we spent quite a lot of time on this morning. I think on that, it's too long off, and I think the most important thing, as Adrian will know too well, is that if actually you were in the same position in state aid, which is that if something's found to be state aid, it's not the country that pays, it's the taxpayer who's built the factories, employed the local people, that has to pay that back, which is, to my mind, a really unfair system because it's double payment by the companies concerned. If you had that behind WTO rules, we'd all be worrying about it a great deal. So it's been intriguing. In some ways, it's been like watching a cruel sport because I really feel sorry for you guys having to come to grips with it. But welcome to our world in the UK with the Finance Act every year. Thank you.
Thank you, Steve. I think this was a pretty good overview of what you would see in Europe. I find it interesting that out of 3 countries you have selected, 2 are the British Isles, and 1 is the continent. Maybe the situation is a bit different when it comes to the overall perspective, but I think these are good people. So I would like to throw a couple of questions to these people, and just to react, their reaction should be very short, very much to the point. As regards compatibility of US tax reform with tax treaties and WTO law, there seems to be a consensus in this room between non-Europeans and Europeans that there is a problem. But how will non-US countries react? Do you think they will do something? The European Union might do something. Will OECD step in? Will WTO procedures be initiated? Adrian, what do you think?
Yes, I think there likely is an issue with both compatibility with tax treaties and the WTO rules and balance. Ireland will not do anything on its own for sure. We're too small, but I think we'd follow the European consensus, and there does seem to be a bit of head of steam developing, if I put it that way, to look at those issues.
Johanna.
I'm pretty sure that the EU will do something about the WTO issues, maybe after the OECD has made its opinion. I think that the tax treaty issues are actually pretty difficult to fix because, I mean, what can the other treaty country do about it? So I would really hope that the OECD steps into it because, I mean, otherwise, we will not cancel our treaties with the US, even if we would say it's a breach of the contracts or of the treaties. So I really don't know what the German position will be on double taxation due to BEAT, for example.
Thank you. Steve?
I think if we were still a foreign tax credit jurisdiction, we'd be more interested and more involved. But because we're all territorial exempt systems, whether something is credible or not doesn't really matter to us. There's a certain amount of skepticism as to whether the US would do anything, even if people told them it was wrong. Great deal of focus in Europe, as I said, and here on state aid, which has got real teeth for the companies concerned. So I think Johanna's right. I think OECD will pick it up. I think EU will then pick it up. One of the reasons, actually, why I'm not really glad, but one of the reasons why I'm pleased with leaving the EU is that I have regarded it as very worrying that the EU has intervened time and again in tax matters, not just through state aid. I think that's fine. I agree you can have state aid. But I think there is a tendency for the EU to get too involved in trying to take a single consolidated tax system. And I think Germany will be an enormous beneficiary of that, but I'm not sure about the smaller countries.
Actually, I do not know whether that will come to any end. But
No,
it's a
maybe
different
not.
story. But I would like to catch up with you, Steve, on what you just said about the digital tax, because the tax on digital services may have a WTO issue as well.
Yeah.
So the question is, to what extent should the Europeans be a bit more cautious here, not moving forward with a tax that is maybe not explicitly but implicitly violating WTO law, and then pleading in the tribunals of the WTO that the US get it wrong.
I mean, we talked about retaliation in terms of WTO law, and it almost looks as if an advanced retaliation is now undertaken, and I think this really heats up the situation. So I would really appreciate if this is left open until we talk about the whole set of problems under WTO law.
And the UK would certainly prefer it if the problem went away, but I think they don't think it's going to, so they're going to have to do some work on it. And we don't come to the debate with clean hands, because in terms of picking up some of Mr. Kleinbard's stateless income, we've imposed withholding taxes on royalty payments going out to non-treaty jurisdictions. And if you look at that and you say, well, the withholding taxes are wrong, aren't they, because they tax gross income, not net profits? And why should you tax somebody just because they're in a tax haven? But then you look at it from the other point of view and you say, actually, if somebody is exploiting intellectual property in my jurisdiction in a way that doesn't create a permanent establishment, actually I have got a right to tax that, because they are, on a simple basis, using the facilities for which other people are paying. You know, all the trucks drive down the roads that have been built, and our wonderful broadband systems have been created at a cost. And I suppose I, therefore, look at the idea of digital taxation as being something which the public, you know, the masses and the press, and in our country, the Public Accounts Committee in Parliament are a complete pain in the neck and going on about things they don't know about, but there might be too big a push at that point. In which case, my suggestion, I don't know whether it solves the WTO, would be that people switch from trying to say a digital presence is a deemed PE and try and fit it within the format of the old regime, which is if you've got beeps on the ground, then you are using the facilities in countries should pay tax, to something that becomes more of a market access fee. And you know, then, to my mind, it has at least philosophical cogency, even though most people would say then, be careful what you wish for, you'll then end up paying more taxes in other countries than you collect in the UK.
And a market access fee is what people called a tariff 100 years ago.
Indeed.
And it's exactly
or a VAT within Europe, you know, but at least it's intellectually honest.
But Steve, I mean, basically you say no country is innocent, so I mean, sometimes you have a withholding tax, and I think if you compare that with a BEAT, I mean, a BEAT is also, you know, a tax on not even income, on actually expenses. So, but I mean, you know, I understand you, I think correctly, that you say if each country on its own just, you know, goes away of unilateral actions, then we have a real mess afterwards. So we would really wish for someone to coordinate, and the question is, will that be the OECD, after the OECD was so engaged in BEPS, which to some extent also brought us to the problem?
Well, Mr. Sentaman has got to find his next job.
I was going to say, Ireland's view is very clear in this. It should be left the OECD for many reasons, but one of which the US will be at that party, and, you know, we shouldn't be trying to have a European solution, and we don't want unilateral action either.
I think what Steve just said about the withholding taxes brings us to bullet point number 2. Will European countries apply defensive measures? Will they apply CFC legislation to the US companies which are now below 25% limits, which are way below those limits when it comes to FDII income, where we have the full expensing, which has a major effect on the tax base, that has to be included when you look at the effective tax rate. Just to give you an example, when the United Kingdom moved below the 25% barrier a couple of years ago, tons of German companies who have bona fide business interests in the United Kingdom were hit by CFC legislation because you always have a couple of passive companies out there who just administrate assets or who just work as treasury functions, and then you're hit, although nothing of that was ever really the reason behind establishing these companies in the first place. So Adrian, what do you think? Will Ireland apply anything? Interest barriers, CFC?
No.
Nothing.
With the
But you have a 12.5%, so why should you? Exactly. That's the point.
I mean, the CFC problem might be really a unique German problem because we have this very high threshold of 25%, which just we didn't lower it when the rest of the world cut their taxes. So that might even be changed in the next years. But as I said already, I mean, the application of the royalty barrier is discussed, and I think there's quite a likelihood that this will happen. And I mean, we talked about WTO, we talked about treaty issues. This is just, I mean, you know, acute because this will apply to the next royalty payment, as I explained it. So this will be definitely applied, I think so.
Yeah. Steve, you have CFC legislation.
Yeah,
you also have the diverted profits tax.
We do, which, you know, in this audience, people will think is directed just at US companies. It isn't. I think the other way to look at it is...
Who are the others? Who are the others?
You should read the UK press.
Okay.
There is one particularly big company that has had to make quite a significant disclosure, but everybody is worrying about it. It's not been the UK's finest hour in terms of administration. I think the way to think about diverted profits tax is that it is domestic transfer pricing with added brutality. If you didn't get your transfer pricing right, you pay a higher tax rate. I don't think the UK will go for any defensive measures. I think, you know, that we've gone through a big tax reform and also have been early implementers of the BEPS process with anti-hybrid. And I think we've got enough at present. So, and I think the UK will leave UK companies operating in the US to fend for themselves. And we'll be worried if there's an impact on inbound investment. But I think we would have a very Irish reaction to that then and try and make the UK even more attractive.
Absolutely, but I think to that extent, this is an atypical panel. Because if we had, let's say, people from France, from Spain, from Italy, from Austria, on the panel, even the Netherlands are somehow moving between the different positions. There might be
withholding tax,
a more forceful reaction. Yeah. So would you think that the race to the bottom will move further? Do you think that other European countries...
Start with that, because I don't think so. It's what we were accused of when we first did our tax reform, and we were called a tax haven. When I came over here, people used to introduce me as Steve Edge from that well-known tax haven. For me, a tax rate of between 15 and 25 should be regarded as normal. I think the points you made earlier on, Wolfgang, that you're paying for something in the country you're going to, and you should pay something that something would recognize as a tax rate. Would I, 5 years ago, have said 20 to 25? I don't know. So am I in 5 years' time going to be saying 10's okay? I don't know, but 15 to 25 seems okay to me at present, and I don't see any pressure in the UK to go lower.
So for Ireland, this is something like, you have been ahead of everyone for a couple of years now, and now they're all in the back. You see them coming. Sure. How does that make you feel?
Sure. Look, we've had a low tax rate, if I can put it that way, for many years, so we didn't have to race there. And if there was a race, as you say, we probably won it a long time ago. But each country is different. You know, we've high VAT rates, we've high income tax rates, and you shape your tax regime, which is a matter of national sovereignty, to really suit your economy. So we won't change our rate. And I have a feeling we're getting near some...
Well, we're much closer than we were.
Yeah. But I also think, I mean, a lot of countries have reduced their rates. Germany maybe is a bit of an outlier. I think the Netherlands may be talking about it a little bit. Luxembourg.
And they got rid of their withholding, which is effectively an additional corporate tax, right?
But my sense is European rates, maybe apart from Germany, aren't going to take a big drop down generally.
That's what I also would assume, that I mean, we have already this high pressure of the European tax competition, which I don't know whether the US tax cut really affects that. What I think is interesting is full expensing and things like that. This might be, another model. I mean, we are now, we have been into the patent boxes. Maybe this is the next round of being attractive and would be maybe even a smarter one than patent boxes. So.
Which brings me to my maybe last question. I would skip the next one here, the bullet point, but number 5, I would like to get, let's say, one big point from you, and that is there anything in the US tax reform you say, wow, this is something my country should adopt as well? Steve?
Sadly, no.
After this morning, definitely not.
Not even full expensive?
I mean, full expensive. We didn't talk about it. Maybe it's as bad as the rest.
Well, and guilty? I mean, guilty is
maybe I should make one point about guilty, because, I mean, if you look at it from a European perspective, you think it is a smart rule of making somehow, maybe even cutting tax competition back to this 12.5% or 10.5%. But I mean, if you look at it, and especially of the structure of this worldwide application, I think this is very difficult to judge what it really does to other competing countries. But I'm pretty sure that the German legislator will look at it very closely, because our CFC regime is, I mean, on paper, it is very strict. But it is, as to my knowledge, hardly really applied as a major threat. And guilty, at first instance, looks easier than, this active-passive distinction. So for that reason, I could imagine that other countries will look at guilty as a new CFC rule quite closely and figure out whether this might be an alternative.
Adrian, something you would copy? Ireland is perfect as it is.
No way, Jose.
Okay, so I think I have 1 minute to wrap this up. You see the reactions are, they are not hostile, they are interested. People are watching out, and they will follow up on what the WTO and the OECD organizations will have to say on this. They will also have a very close look at the implementation, in particular of the BEAT. I think the BEAT is the most hostile element. It's also the element which makes the US drift to a large extent away from existing tax treaty policy. And the Europeans do not have to prescribe the US people what they have to do, but one thing we would wish for is that you know what you do, and that you know which treaties you violate, and that you know how the position is and where the international consensus stands. And given the fact that recent years have seen this enormous amount of coordination under the agenda, not only of OECD, they praise themselves, but it's basically the G20. The G20 with the heads of states coordinating their policies. That is something very valuable, and one should not give that up very easily. That's a matter that goes way beyond tax. Thanks for having us here, and I wish you a good afternoon. Thanks.
Okay, thank you, Wolfgang, Steve, Adrian, and Johanna, for your comments from a European perspective on U.S. international tax reform. It is now my honor to introduce to you Professor Joshua Blank, who's the faculty director at the Graduate Tax Program at NYU Law School, and for some brief comments. And then Professor Blank will then introduce our keynote speaker. Professor Blank.
Thanks, Larry. Good afternoon. My name is Joshua Blank, and I teach here in the Graduate Tax Program at NYU Law School. And on behalf of the Graduate Tax Program, I'd like to extend our thanks to KPMG for sponsoring this annual event. This has been one of the highlights of our academic year for the last 18 years here at the law school. The program offers our students the opportunity to think about important tax issues, like obviously the new tax law today, but also it gives them a chance to meet the entire tax community in the New York area and beyond. And every year we hear from our students about how much they appreciate just having the chance to meet tax practitioners from law firms, accounting firms, and government, and this is really one of the best events for that opportunity. I'd especially like to thank and acknowledge Larry Pollock for all of his work in making this event happen in his role as director of the NYU KPMG lecture. And if we can just take a moment to acknowledge Larry for a great job. And last, I'd also like to, on behalf of the tax program, thank all of our alumni who are here today. Our alumni support the graduate tax program and the international tax program in many ways by teaching here as adjuncts, appearing on panels, mentoring our students and our recent graduates, and supporting initiatives of both the tax program and the international tax program through the Wallace Lyon Eustace Fund. We're deeply grateful to all of you and again to KPMG for your support of this program. It's now my honor to introduce our keynote speaker, Tom Barthold. Tom is the Chief of Staff of the Joint Committee on Taxation. He joined the Joint Committee as a staff economist in 1987, and he subsequently has served as Senior Economist, Deputy Chief of Staff, and Acting Chief of Staff. He has been Chief of Staff since May 2009. Over the past 3 decades, he's worked on a wide variety of issues for the committee. Before arriving in Washington, he was a member of the economics faculty at Dartmouth. For his work at the Joint Committee on Taxation and the Tax Council Policy Institute awarded Tom its Pillar of Excellence, and the National Tax Association has awarded him the Bruce Davey Albert Davis Public Service Award. Please join me in welcoming Tom Barthold.
Thank you. Well, good afternoon, and thank you very much for the opportunity to be here with you today at New York University Law School, which I actually want to give a special thanks to because over the years they've sent us many fine graduates who have served on our staff and I think contributed greatly to the work of the Joint Committee. The conference today has got this great title of the Tax Cuts and Jobs Act, but of course you know that's not really its name. It's Public Law 11597. It was formerly known as the Tax Cuts and Jobs Act before the application of some of the Byrd rules that are applicable in terms of consideration of reconciliation legislation in the Congress. I was asked to try and entertain you, give you some insights, perhaps get an opportunity to answer questions. I also have a responsibility to be bland, not be quoted saying outrageous things in the tax press. That's more appropriate for the other panels, and the panels this morning were interesting. So I thought what I should do is start with sort of broader context. As was just noted, I've been on the Joint Committee staff for more than 30 years. I joined just after the passage of the Tax Reform Act of 1986. And between 1986 and this past December, the Congress has enacted a number of large tax bills, but none, I think it's fair to say, have been as sweeping in terms of the changes that they've made in terms of business taxation in the United States, and in particular, cross-border taxation. So let me try and give a little bit of context over the 30 years, because while there was not many major changes between 1986 and 2017, concerns of cross-border income earning, what multinationals are doing, how multinationals are taxed, be they US based or be they foreign based multinationals, has been a long concern of the US Congress. Let me break it up into roughly 3 decades. It's going to be not perfect division and not perfect chronologically. But if we look at the economic landscape just after the 1986 Tax Reform Act, think of the period roughly 1986 to 1994. What's the economic landscape? What are some congressional concerns? After the 1986 Tax Reform Act, the U.S. corporate income tax rate was about the lowest of the major industrial economies. So for the most part, you could say lower than the rest of the world. What were concerns that Congress had at the time? The concerns were runaway plants. And I mean by runaway plants, the classic idea of shutting down a factory operation in the United States, opening it up somewhere where the somewhere typically had 2 factors, perhaps a lower tax rate because it was a less developed country, but often less expensive labor. You had notable legislation introduced during that period by then Congressman, later Senator Byron Dorgan. Actually something for the local scene, for those of you that are old enough and remember your New York Senator, Alphonse DeMonto. he carried out a notable filibuster on the Senate floor regarding trade legislation that he thought would affect a runaway plant. Smith Corona was going to close a typewriter factory in upstate New York, and I know from the chortles in the room that that's viewed as quite a quaint concept, both in terms of perhaps the issue of a runaway plant as well as the issue of what is a typewriter for several of you in this room. Well, the Ways and Means Committee was concerned about general issues in international competitiveness, cross-border taxation, who's investing in the United States, who's investing abroad. And in late spring of 1991, they held a series of hearings. Remarkable both in terms of the scope of the hearings. I think it tells you a little bit about the way Congress operates then as opposed to the 21st century Congress. But the Joint Committee staff at that time, as we routinely do, produced background information for that hearing. For those of you that want to go back into the record, it's document JCS 691. It's over 500 pages in length, laying out law and issues. It's one of the more substantial documents that we've produced over the years, called Factors Affecting the International Competitiveness of the United States. That was the core issue that the Ways and Means Committee was worried about. The committee held 9 days of hearings with multiple panels. It's a lot different than the way the Congress operates today, but I note that because among the issues that the Joint Committee staff highlighted were the effect of the U.S. savings rate, the effect of the deficit, outbound flow of assets, what that might mean in terms of foreign purchases of U.S.-based assets, what it might mean for the location of investment. Those hearings were actually followed up by an initiative by then Chairman Dan Rostenkowski, and on a bipartisan basis, Republican Congressman Willis Gradison, the Foreign Income Tax Rationalization and Simplification Act, which would have relaxed some of the foreign tax credit restrictions enacted in the '86 Act, would have provided for worldwide interest allocation, would have repealed deferral, among other things. And that was introduced in 1992. Well, as you know, that went nowhere. So let me jump to the next period. Let's take the decade roughly 1995 to 2005. The economic landscape, I think it's fair to say, had begun to evolve, change. Congressional concerns changed somewhat with them. By now, a decade later, you have a lot of other major economies catching up in terms of how we tax foreign businesses. Foreign tax rates were falling, in part in response to the Tax Reform Act of 1986 in the view of many. You had a pickup in cross-border merger and acquisition activity with foreign dollars buying U.S. assets, as had been suggested in some of the, and discussed in some of the hearings some 6-7 years before. Inversions. You were starting to see the first inversions of U.S. corporations. The Clinton administration blessed the Helen of Troy inversion. I believe it was in 1996. World growth over this period was quite good, and for U.S.-based multinational corporations, you started to see profits pile up abroad because of the incentive provided by being able to defer and the effect of lockout for returning repatriated dividends. And then in this period, you both saw the dot-com boom and bust, and you saw post 9/11 recession. Sort of the general economic landscape. Politically, worldwide, a move to a single Europe. You had the WTO challenge against the Fisk regime in 1997. The congressional concerns had really sort of evolved. Thought that there was maybe some, in some aspects, the Tax Reform Act of 1986 had been too stringent. And so in 1998, you first saw the active finance exception enacted to say that what had been deemed passive-based income could represent active business activity if properly measured. You saw the beginnings of anti-inversion legislation. You had the 2000 response of creating the extraterritorial income regime, ETI, in response to the Fisk decision, and then ultimately that evolved into, in 2004, the American Jobs Creation Act, AJCA, which notably in terms of cross-border activity included not just the domestic production activity exception of deduction of Section 199, which was the direct response to the Fisk and the ETI decisions, but also enacted CFC look-through for US-based multinationals, and significantly had the elective Section 965 repatriation holiday. Concerns at this time politically also involved base stripping by foreign-based businesses operating in the U.S. and by inverted U.S. corporations. The U.S. Congress had called on the then called the Government Accounting Office, now called the Government Accountability Office, the GAO, undertook several studies on the level of taxes or the effective tax rates of foreign-based companies as opposed to U.S.-based competitors. Treasury was mandated to undertake a study of possible earnings stripping by foreign-based multinationals and by formerly U.S.-based companies that had inverted. Again, the tax writing committees themselves held some major hearings at this in this period in response to these concerns. Ways and Means and Finance, both over this period, had some significant hearings. But beyond, as I noted, active financing exception, anti-inversion legislation, and the American Jobs Creation Act, nothing really big yet. The more modern era, let's say take it as post-2005, I think over the last decade, the last 12, 14 years, you've actually seen more intensity of concern about how the U.S. fit into the world system, how our system might affect incentives for investment in the U.S., incentives abroad. The U.S. corporate rate now is clearly seen as greater than that of the rest of the world, notably with, I guess now 3 years ago, the reduction by the Japanese. So to my German friends on the last panel, you said you like to take pride in pointing to the United States as having a higher tax rate than you. I think Japan still has you beat by a little bit, so you can take a look at the Japanese. Hope that's a helpful thought for you there. If anything, over the last 12 years, I think you've seen an increase in both cross-border merger and acquisition activity and inversion pressure and political concerns that arise from that. Some notable U.S. brand names, for example, would be Anheuser-Busch, Heinz, among others, for those of you that like to go to a ball game and have a beer and hot dog, that sort of thing. Again, even after the elective repatriation holiday of AJCA, reported profits held offshore have grown rapidly, again, with a pickup in worldwide growth. And also over this period of the last 10 plus years, more countries shed the vestiges of a worldwide taxation system and have gone to dividend exemption systems, leaving the United States as more of an outlier. Well, what were the congressional concerns over this period? Loss of tax base was a significant concern. Many of you in this room might recall that in Ways and Means in 2010, the Ways and Means Committee held a notable hearing on income shifting, for which they had asked the Joint Committee staff to prepare a report. The report was based on some case studies of multinational corporations and laid out ways in which income, particularly that from intellectual property, might be cited abroad, reducing the U.S. tax base relative to what you might see as the sales and underlying reported financial profitability in the domestic market as opposed to the foreign market. And I'll note that, in fact, that work that the committee undertook in its investigation predated the BEPS, the entire BEPS project. Part of that work was, in fact, cited in the initial BEPS report. The concern, not just with the tax base loss, was in noting that intellectual property perhaps was being shifted, was a concern of Congress. Do jobs follow the intellectual property. Lockout of domestic investment from accumulated foreign earnings remained a significant congressional concern and a question of to what extent was foreign investment a substitute for U.S. investment, or to what extent was it a complement for U.S. investment? When did growth abroad help promote growth in the United States? When was it at the expense of growth in the United States? In addition to then, over this period, the initiation of the BEPS project within the OECD, saw congressional concerns about state aid cases. Maybe we should characterize this as an economic nationalism concern by some members of Congress. Were U.S. companies being targeted, and were they being targeted to the detriment of potential future growth by those companies or future growth in the U.S. economy? I note these things because I think in many ways you sort of see a drift of concerns along with drift in the changing economic environment away from that classic runaway plant concern that was there 30 years ago when the Congress was first addressing cross-border issues and issues of international competition. Over this period, if anything, what to do, considering different ideas, looking at what's happening in Europe, what's happening in Asia became much more of a focus of the congressional committees. The Ways and Means Committee, for example, held hearings in 2006, 2010, 2011, 2017, complemented by their counterpart on the Senate side with the Finance Committee holding hearings in 2007, 2011, 2014, 2015. All substantial hearings asking for academic comment, asking for practitioner comment, asking for comments from the business sector. At this time, during this period, you also saw much more active attempts at trying to advance potential change. Chairman Dave Camp, former chairman of the Ways and Means Committee, initiated a series of working groups to get the members to do outside the hearing process some in-depth study. And as I think most everybody in this room is aware, in 2014 introduced some of his ideas for how you might move the United States to a territorial system, lower the corporate tax rate, have a very broad business tax reform. You'll remember in that context, in the current day context, Chairman Camp's option C. On the other side of Capitol Hill, you had, again, in a bipartisan basis, you had Democratic Chairman of the Finance Committee, Max Baucus, introduce a series of discussion drafts of possible options to, again, move the U.S. tax system in cross-border taxation away from where it had been since the 86 Act. With the change in congressional majority, current Chairman of the Finance Committee, Orrin Hatch, again, established his own, his series of working groups, somewhat paralleling the work that Dave Camp had done. Again, to try and study in depth, come up with options. And again, I note, because of the bipartisan aspect of it, that the International Working Group, which was headed by Senators Portman and Senators Schumer, basically gave a bipartisan endorsement to, let me just characterize it as something territorial. In other words, moving away from the worldwide system, doing something that maybe moved the United States to conform more with the rest of the world. Well, that's kind of a quick but also long walk through 30 years. Just to summarize, I think some of the classic runaway plant concerns have receded. It's not so much about specific plants. The concern has been much more about what's the growth potential in the United States? What's the employment potential? Is it a good job? Is it a good job potential? Base erosion has increased as a concern. Base erosion both not from just that the plant leaves, but is it the engine that leads to future economic growth? Some of the intellectual property, some of the research jobs. Is that fleeing? Is the tax system working against retention of those? There's also a concern in that respect of to what extent are multinational corporations, be they US-based or when you look inbound, the base concerns on inbound investment, to what extent are multinational corporations paying their fair share? Again, not a well-defined economic concept, but an important political concern. And let me not downplay what I characterized as potential thinking in terms of economic nationalism. The loss of headquarters operations and what are considered headquarters jobs of good jobs, skilled jobs, high-end jobs is an important concern for many members. And I emphasize all those because a number of those concerns have had now for 2 decades a clear bipartisan flavor to them. Now, obviously, the legislation that was recently passed, Public Law 11597, for lack of a short title, was passed on a partisan basis. There's no denying that. You've had a lot of discussion about the international provisions this morning. We're about to have more later. We're going to get an in-depth analysis, economic analysis from my friend Alan Viard in a little while. Let me just give a few high-level thoughts here. First of all, I outlined these concerns. Do we think the law was trying to do, Public Law 11597, was it doing something to try and address those concerns? Well, in simple terms, sure. Think of the runaway plant, the growth. Well, what's the first, kind of a first order reaction in terms of the policy initiative? Reduce the corporate tax rate to make after-tax returns in the United States more attractive. And moreover than just reducing the corporate tax rate, let's have 100% expensing, because economically 100% expensing basically means we've exempted the entire normal return to the capital investment. So if that's not a pro-growth, pro-domestic growth policy, there's not much that is. Now there's other things that damp that, the interest, changes in interest limitation, changes in NOLs. There's a number of other important details that I gloss over, but in terms of a broad policy goal, you can see part of 30 years of thrust of policy concern addressed with those provisions. Outbound, the base erosion problem. Well, again, members think both in terms of outbound investment and in terms of encouraging inbound investment, that those policies above, lower rates and expensing, are good things. They moved to tried to address the concern of, are we out of step with the rest of the world by let's create a dividend exemption system. Is it a pure dividend exemption system? No. Did we have a pure worldwide system? No, but moved the basic structure toward ones of dividend exemption. Yet a long-term concern had been that issue of what happens to intellectual property, what happens to high-end jobs, what happens to research jobs. Think of the BEPS project, think of the hearing work that the Ways and Means Committee had done. That's what motivated, as has, I think, been explained this morning, both the GILTI regime and the FDII regime. Now, also noted, and I don't think it's been talked about yet today in terms of inbound investment, it's been some note, new limitations on all corporations on interest limitations in addition to the BEAT proposal. Again, I'd mentioned economic nationalism as a concern that's laying there. Again, I think it's a story partly of rates, partly dividend exemption. They've seen some cross-border, I think it's fair to say a number of members have interpreted our worldwide system as giving an edge to headquarters that are not under a worldwide regime. And so I believe they think that addresses some of those concerns. Now, I know you want me to say something more specific about the bill, and this is where I have to be really careful. So let me just take a couple minutes with a couple high-level observations on some criticisms. And this is not to defend the legislation in any way, but just to make some remarks about how we think about analyzing some of the outcomes and maybe some of the choices, some of the motivation. I think it's important to keep in mind when we think about what we're looking at and how people are going to plan for the next 5 years, 10 years, however they respond, to think about what the baseline of comparison is. I've read a number of criticisms in the tax press or people that have come in to talk to our staff that seem to take as their baseline of comparison a perfect system, and that, gee, you created something that didn't line up with a perfect system. Well, that just doesn't seem like the way to think about it to me, and I don't think it was the way the members of Congress thought about it. They were trying to think of, we're trying to move from where we are in some of these directions that address the concerns that I outlined. As a particular example, and I think this reflects what economists would call a very partial equilibrium analysis, I've read multiple comments where people have said, well, let's look at the GILTI, and under the GILTI, there's this 10% deemed return on a threshold of tangible assets. Well, obviously, that just means that that promotes an outflow of tangible assets from the United States. Really? If we were in 2017 and we wanted to establish a plant in Singapore, where under a special agreement you could effectively have a zero tax rate, is anything different now? If you took the tangible assets and you could get a 10% rate of return? I don't think so. And in fact, if you did that plant in the United States, if you noted because you could expense it, you'd have effectively get a zero rate of return on those assets. And you might say, and under the GILTI, if you were in Singapore in 2018, then there might be some return that potentially would be taxed, depending on your worldwide situation. So it's very partial equilibrium analysis to say, oh, look at those deemed assets, put a 10% return and say, there's obviously an incentive to ship assets out of the United States. Another criticism I've heard somewhat repeatedly is that it's clear that all the estimates of this estimated revenue effects of this legislation were wrong, that there's going to be a massive revenue hemorrhage, vastly understated by the work that the Joint Committee did and that the Congressional Budget Office did. Now, this is based on two lines of thinking. One, will Congress permit the expired provisions to remain expired, or those provisions that have phased-in increases to actually become phased in? Valid question. The budget rules remain in place. Voters can have their say. Can't comment on that to the extent that you think that that's the way the politics will play out. That's completely correct. But I've also heard criticism that's a little bit more on the line, and I will say I reject it as somewhat glib, the comments by some that say, well, there's a lot of smart people out there. The example would be most of you sitting in this room. And then we're oh so smart that surely the revenue estimates on which the members base their decisions are wrong. And they're obviously always wrong in the same direction. On a very static analysis, if you went and you looked at data on cross-border intercompany trade, like from the Commerce Department, and you said, let's look at how that BEAT tax lays out, you would calculate very roughly a number that's substantially bigger than the number that the Joint Committee staff reported to members of Congress as what we thought the estimated effect would be. And that's because we spend a lot of time talking with folks at the Treasury, talking among ourselves, talking with constituents who would come in and say, oh, well, if this is the way things are going to be, we think we could do this, we think we could do that. We tried to build in a lot of that behavior, and I think it's a little bit simplistic to say, oh, it's obviously wrong, and they obviously always missed on the downside. Not saying our estimates were perfect. They didn't come down from Mount Sinai, but still time to play that out. We gave it, tried to use the best analysis that we could, and we did not assume that people would not respond, that tax planning would not happen. We assumed tax planning would happen. Well, I have 2 minutes left here, and I can use that to take a couple questions, or I could tell you a little bit about kind of current process of technical corrections and the like. So questions or process? Process, okay. Well, the process is Our phone lines, our email lines are open. We're soliciting anybody's views if they think there are technical errors. The process of identifying technical corrections actually began before the legislation was signed. We noticed that there were some errors, conflicts between what the members had directed in terms of the conference agreement and the way it worked out in the statutory language, partly a consequence of it being a somewhat compressed time period to pull everything together. We try and hold a technical correction itself is not something that's small. It's not something that benefits one taxpayer. A technical correction from our perspective is what was the member's intent in the legislation. If the member's intent was clear and it's not clearly reflected or clearly effectuated in the legislation, then perhaps a technical correction is required. We vet the thinking of these with the Treasury Department, with the Ways and Means staff, the finance staff. We try to do it on a bipartisan basis. That's a little bit different this time than there are in the case of other legislation because of the more partisan nature of crafting the bill. Along with the technicals process, the Joint Committee staff is planning on producing a blue book that tries to explain, pull together the different pieces of legislative history all in one place. We'll use the blue book to identify some areas where I think technical corrections might be needed. We hope to write better some of the explanation of some of the provisions, perhaps provide a few more examples, but the blue book is not an effort to try and expand the policy or change the policy in any way. It's an effort to try to be helpful. In terms of timing, the timing of Blue Book is really driven by members of Congress. They have other things they want us to do, so it somewhat depends what else is going on in Congress. In terms of technical corrections, my colleagues on staff, and we coordinate the technical corrections process, we hope to develop at least an initial list of technical corrections that are agreed to by all parties. We would then hope that the chairman of the two tax writing committees, and we would also hope that the ranking members would join them in introducing legislation. This legislation typically does not get passed rapidly. Technical corrections that were developed after the passage of the PATH Act in 2015 were first introduced in December of 2016 and were only passed into law 6 weeks ago. The technical corrections to the 86 Tax Reform Act, quick quiz since it's a law school. 86 Tax Reform Act was passed in October of 1986. When were the first technical corrections to the 1986 Tax Reform Act passed? TAMRA, October 1988. They were introduced, there were some introduced before the end of the first session in 1987. We hope to have some technical corrections in legislative language that the members would be willing to introduce yet this session. No hard deadlines. I'm well over my time. I appreciate your indulgence. I hope my walk through 30 years of history was somewhat interesting for the context. And I commend you for just thinking through these issues, and some of the questions that you've raised and you posed to Treasury are questions that my colleagues and I are also pondering. Thank you very much.